In 2021, if you took $10,000 and parked it in, like one of the most popular, supposedly elite cash equivalent funds on the entire market.
Oh, yeah, the ones everybody uses.
Right, those exact ones. You would have made exactly $2 for the entire year.
Wow. $2 on 10 grand.
$2, basically nothing. But, fast forward to today, and that exact same fund, holding the exact same type of assets, is paying out over $400 annually on that same 10 grand.
Which is just a staggering difference. I mean, the asset didn't magically become a better product overnight.
Exactly. The macroeconomic world around it completely fractured and rebuilt itself, and you constantly see financial headlines screaming about the risk-free rate, right?
Like constantly. It's everywhere.
Yeah. And if you have cash just sitting in a checking account doing absolutely nothing, you really start to wonder if you're just leaving money on the table.
You definitely do. But, hey, before we get too deep into the weeds on this, I do need to state clearly, this analysis is for entertainment purposes only. Consult a professional for your specific case.
Got it. So today's mission, we are doing a deep dive into the investment thesis for short-term treasury bills, or T-bills.
The absolute heavyweight of the cash world.
Yeah, and we've got a great stack of sources today. We're pulling from Vanguard's latest 2026 fixed income reports, some really interesting Schwab analyst notes, and the actual granular prospectus data for the two biggest exchange-traded funds in this space.
SGOV and VBIL.
Exactly. But before we pit them against each other, let's just set the stage. When we talk about a cash equivalent here, we're talking about loans you make to the U.S. government that mature in 3 months or less.
Right, exactly. To really conceptualize the mechanics here, holding a T-bill ETF, it's not an investment in the traditional sense.
You're not like hunting for massive growth.
No, not at all.
Yeah.
You aren't buying a piece of a growing company hoping the stock price rockets to the moon. You are prioritizing absolute liquidity, and you're attempting to basically eliminate credit risk.
Because it's the U.S. government backing it.
Precisely. These instruments are backed by the full faith and credit of the United States. So they essentially form the baseline risk-free rate.
The baseline for, like, everything else.
Yeah, literally every other financial asset on the planet is priced against that specific rate.
I've always pictured a T-bill ETF like a high-end valet service for your cash.
Okay, I like that. How so?
Like, you hand over the keys and they park your money in the most heavily guarded garage imaginable. Perfectly safe.
Right.
But the mechanism is actually a bit more active than that, isn't it? The valet doesn't just let the car sit there collecting dust.
No, they definitely do not.
They essentially lend your vehicle out overnight to the safest driver in the world, the U.S. government, who then pays a rental fee for the privilege.
That's a great way to think about it. And the valet, which is the ETF provider in this analogy, they take a tiny fraction of a percent as a management fee.
And then they just pass the rest of that rental income directly back to you.
Exactly. And the current data from early 2026 shows that that rental fee is still pretty substantial.
What are the numbers looking like right now?
So looking at the incumbent in this space, the iShares 0 to 3 month Treasury Bond ETF, ticker SGOV.
The giant in the room.
Yeah, the absolute giant. The fund is showing a trailing dividend yield of about 4%.
Okay, 4% sounds great for cash.
It does, but, and this is a crucial distinction here, there's a big difference in the metrics you see on the screen.
Right, because trailing yield is just looking backward.
Exactly. The trailing yield only tells you what happened over the last 12 months. It's historical. The far more important number that you really need to look at is the SEC yield.
And where is that sitting right now?
Currently, it's sitting quite a bit lower at 3.58%.
Okay, let's actually pause here and make sure I understand the calculation behind that SEC yield. Because, you see both of these numbers plastered on every single fund page, and it can be super confusing.
Oh, it tricks up a lot of people.
Right. So trailing yield is basically the ghost of interest rates past. It includes payouts from, like, 8 months ago when rates might have been a lot higher.
Yep, it's an average of the past year.
But the SEC yield, that's a standardized formula, right? Created by the Securities and Exchange Commission specifically to strip out all that historical noise.
You nailed it. It looks strictly at the income the fund generated over just the most recent 30-day period.
Oh, just 30 days.
Yeah, it takes that 30-day income, deducts the fund's expenses, and then annualizes that figure.
So it's projecting that recent snapshot forward.
Exactly. It's the closest thing you can get to a real-time snapshot of the fund's actual earning power today.
Okay, so if the SEC yield is lower than the trailing yield, which it is with SGOV right now, 3.58 compared to 4%, That basically guarantees that the interest rates on the underlying Treasury bills have been falling.
It is a mathematical guarantee, yes. Rates are coming down.
Which means the payouts you, the listener, receive next month will be closer to that 3.5% range than the 4% range.
Right. You have to temper your expectations based on the SEC yield, not the trailing one.
But still, getting 3.58% annualized just for holding cash, that is still a massive structural advantage compared to the 0. Nothing percent sitting in a traditional brick-and-mortar checking account.
Oh, absolutely. It's not even a contest. Earning that yield without taking on credit risk really protects your purchasing power against inflation.
But that obviously brings up the big question, how did we actually get here? Because, like we said at the start, if we look at the SGOV prospectus back in 2021, the total return was a microscopic 0.02%.
Yeah, your cash was essentially frozen in amber back then.
So what broke the amber?
The central mechanism driving all of that volatility is the Federal Reserve. Specifically, their control over the overnight lending rate.
Which directly dictates the yield on a 3-month Treasury bill.
100%.
Yeah.
In 2021, the Fed had rates pinned to the floor, basically at zero, to stimulate an economy that was still recovering from a massive global shock.
Right. Money was basically free.
Exactly. But as inflation surged over the next couple of years, they aggressively hiked interest rates to cool the economy down.
By making borrowing way more expensive.
Right. And the transmission of that policy is immediate in the T-bill market, like instantaneous.
Because these bills only last a few weeks or months anyway.
Yeah, so as new 3-month bills were issued at these much higher rates, SGOV's returns jumped massively.
I'm looking at the data here. It went to 5.13% in 2023.
And it actually peaked at 5.28% in 2024.
Wow. So the yield on this supposedly risk-free asset is entirely at the mercy of whatever macroeconomic lever the central bank decides to pull on any given day.
That is the perfect way to phrase it, yes.
And looking at Vanguard's active fixed income perspectives report for the first quarter of 2026, it looks like that lever has been pulled aggressively in the other direction now.
Oh, very aggressively. Vanguard notes that in 2025 alone, global central banks cut interest rates over 120 times combined.
120 cuts in 1 year.
Across the globe, yeah. It was a massive pivot.
And the specific phrasing Vanguard uses for the U.S. Federal Reserve is that they have, quote, largely completed their risk management easing.
Yeah, and risk management easing is a really vital concept to grasp here.
Let's unpack that because it sounds like corporate jargon.
It does, but it means something specific. See, the Fed wasn't cutting rates recently because the economy was collapsing into a recession.
Which is usually why they cut rates, right? To save a dying economy.
Exactly. But this time, they were cutting just to normalize policy. They had rates incredibly high to fight inflation.
And once inflation actually cooled off?
Right. Once it cooled, keeping rates that high would have needlessly choked off economic growth.
It would have caused a recession on purpose.
Exactly. So they eased policy to manage that risk.
Yeah.
But the consequence for cash investors is pretty stark.
The high watermark for T-bill yields is firmly behind us.
Firmly in the rearview mirror.
And Vanguard's active fixed income team goes incredibly hard on this exact point. In their Q1 2026 report, they literally declare cash is dethroned.
It's a bold statement for a very conservative institution.
Seriously. They argue that investors will now find better total returns by moving money out of cash and into intermediate duration bonds.
Yep, moving further out the yield curve.
But, and this is where I get a little tripped up, then I look at the Charles Schwab analyst report on SGOV.
Okay, what are they saying?
Schwab gives SGOV a market edge score of 2, which actually indicates mildly improving conditions. Right. So how do we reconcile Vanguard screaming that cash is dead with Schwab signaling that conditions for a cash ETF are actually improving? It feels contradictory.
It really does seem contradictory on the surface.
Yeah.
But it all comes down to reinvestment risk versus absolute liquidity.
Okay, walk me through that.
So when Vanguard declares cash is dethroned, they are analyzing the market entirely through the lens of a total return portfolio.
Meaning someone trying to grow their wealth over time.
Exactly. Imagine you have cash in SGOV today, earning roughly 3.6%. Because the underlying treasury bills mature every few weeks, the fund constantly has to take your money and buy new bills.
Right, they're constantly rolling them over.
Yes. So if the Fed continues to cut rates, SGOV will be forced to reinvest your capital into lower and lower yielding bills.
So your yield just steadily drops month after month.
Right. While an intermediate duration bond, say like a 5-year corporate bond, has a fixed coupon.
So if you buy it today, you lock in today's yield for the next 5 years.
Exactly. You are completely immunizing yourself from the Fed's rate cuts over that specific time frame.
You capture the yield, and additionally, as rates fall, the underlying price of that 5-year bond actually goes up.
Which is the total return advantage that Vanguard is highlighting there.
Okay, so that explains Vanguard. But what about Schwab? Why are conditions improving for cash?
Because Schwab's rating is looking purely at the asset's utility as a cash vehicle in the current environment.
Not as a long-term investment.
Right. If your goal is absolute liquidity and principal safety, you cannot put an emergency fund into a 5-year corporate bond.
Because if a market panic hits tomorrow and you need cash immediately to fix your roof.
Exactly. The corporate bond market might completely seize up, or the bond's value might drop due to credit fears. You lose money.
Ah, I see.
So SGOV's conditions are improving in Schwab's eyes because inflation has cooled down, meaning the 3.58% yield you get today actually represents a positive real return against current inflation levels.
Oh, that makes perfect sense.
Mm-hmm.
So Vanguard is talking to the person trying to build a retirement portfolio over a decade, and Schwab is analyzing the vehicle for someone who needs to write a check next Tuesday.
You nailed it. Different goals, different tools.
And the Reddit thread we pulled sources from perfectly illustrates this exact thing. A user named SpringTucky101 actually listed out their exact use cases for these T-bill ETFs.
What were they using it for?
Things like property tax escrow, pooling home insurance premiums, and storing an emergency fund.
Money that absolutely cannot evaporate in a stock market correction.
Exactly. But if you are using this for something as critical as an impending property tax bill, we need to address a structural quirk of these ETFs that looks genuinely terrifying on a chart.
Oh, you're talking about the sawtooth pattern.
Yes, the sawtooth price pattern. I was reading research from the wealth management firm One Day in July, and they highlighted this exact phenomenon.
It catches a lot of new investors off guard.
I mean, think about it. If SpringTucky101 needs to pull out $10,000 to pay property taxes, and they pull up the 1-year price chart for SGOV, it looks like a staircase that suddenly drops off a cliff at the end of every single month.
It really does.
It genuinely looks like the ETF is experiencing a mini market crash every 30 days.
Yeah. To the untrained eye, seeing a sudden drop in net asset value, or NAV, triggers immediate panic. You think you've lost your money.
But you haven't, right?
No, not at all. Understanding the structural mechanics of how an ETF prices its underlying assets explains exactly why this happens.
Walk us through the math.
So SGOV holds a basket of actual treasury bills. Every single day, those bills accrue a tiny, tiny fraction of interest.
Because they're loans to the government.
Right. And unlike a traditional company stock where the price is driven by market sentiment, like, oh, they had a bad earnings call, the stock is down.
Yeah.
The NAV of a treasury ETF is essentially just a math equation.
It's just adding up the cash in the vault.
Exactly. As that daily interest piles up inside the fund's accounts, the ETF literally becomes more valuable. Consequently, the NAV climbs steadily, day by day.
And that creates the upward slope of the sawtooth on the chart.
Yep. The staircase going up.
The fund is getting richer from the interest, so the share price creeps up to reflect that stored cash. But the fund doesn't exist to just hoard cash forever.
No, it exists to distribute it to the shareholders, which is you.
Right.
So on the ex-dividend date, which is usually the first business day of the new month, the fund takes all that accrued interest and pays it out as a cash dividend.
Into your brokerage account.
Yes. And the critical mechanism to understand here is that the moment the cash is earmarked to leave the fund and enter your account, the net asset value of the ETS must structurally adjust downward by that exact amount.
It has to, right? Otherwise, arbitrage traders would completely exploit the fund.
Oh, they destroy it.
Yeah, if the price didn't drop, high-frequency traders would just buy millions of shares the day before the dividend, collect the cash, and sell the shares the next day at the exact same price.
Essentially draining the fund of capital for free.
Exactly. So the price drop isn't a loss of value. It's just the mathematical transfer of value from the ETF's share price directly into your cash sweep account.
Bingo. The total value of your position, the shares you hold, plus the new cash in your account, remains completely identical before and after that drop.
It's a feature of fund accounting, not a bug in the market.
Precisely. Don't panic when you see the drop.
Okay, so now that we understand how the engine actually works, let's look at the vehicles themselves. Because if you're sitting on cash and want to utilize a T-bill ETF, you're generally choosing between two absolute heavyweights.
SGOV and VBIL.
Right. Let's start with the incumbent, iShares SGOV.
Okay, so SGOV launched in May 2020, and it tracks the ICE 0 to 3 month U.S. Treasury Securities Index.
And it is massive.
It's an absolute behemoth in the financial system. It holds roughly $75 billion in assets.
That's billion with a B.
Yeah. iShares charges an expense ratio of 0.09%, and the share price fundamentally hovers right around $100.
Okay, so that's the reigning champ.
Yeah.
But the challenger in this space is Vanguard's VBIL.
Right.
It just launched very recently in February 2025. But, because it has that massive Vanguard marketing machine behind it, it immediately amassed $4.6 billion.
Which is a huge launch.
Huge. And it tracks a slightly different index, the Bloomberg 0 to 3 month Treasury Bill Index. It boasts a lower expense ratio of just 0.07%.
Cheaper than SGOV.
Yeah, and its share price sits lower too, right around $75. So on paper, VBIA has the lower fee, and the golden rule of passive index investing is always that the lowest fee wins.
Usually, yes.
Yet we found a really fascinating anomaly discussed in the RETF's Reddit community. Logically, VBIL's 0.07% fee should make it the clear winner in total return against SGOV's 0.09%.
That's basic math.
Right. But when you compare the actual performance charts, SGOV consistently shows a slightly better total return.
Which doesn't seem to make sense.
No. I mean, we're talking about a microscopic outperformance of maybe 1 or 2 basis points. But the more expensive fund is mathematically winning. Why?
It's a great question. And synthesizing the sources reveals 2 deeply technical reasons for this.
Okay, let's get into the weeds.
The first is index methodology. Like you mentioned, SGOV tracks the ICE index, and VBIL tracks the Bloomberg index.
Right. 2 different rule books.
Exactly. They don't just buy a generic 3-month bill. They have to build a complex ladder of newly issued 4-week, 8-week, and 13-week bills and constantly roll them over as they mature.
So it's very active internally.
Yeah. The ICE index and the Bloomberg index have slightly different internal rules for exactly how they weight those specific maturity bands on any given day.
So SGOV isn't like magically generating alpha.
No, it just happens to be tracking an index recipe that holds slightly higher yielding bills in this specific market environment.
Okay, so the difference in the underlying assets accounts for a fraction of that divergence. But the second reason is entirely structural, right?
Yes, and it comes directly from Vanguard's own advisor research regarding primary and secondary market liquidity.
This part is wild.
It is. It exposes the hidden cost of the bid-ask spread on lower-priced ETFs.
Let me walk through the spread math on this because it honestly blew my mind when I finally grasped it.
Go for it.
Okay, so both SGOV and VBIL are massively liquid, meaning they trade on the open market with the tightest possible bid-ask spread, just 1 cent.
Right. The market maker takes a penny every single time you buy or sell.
But the share prices are different. SGOV is a $100 stock. VBIL is a $75 stock.
Exactly.
So 1 cent on a $100 share is a cost of exactly 1 basis point. But 1 cent on a $75 share is a cost of 1.33 basis points.
Which means the percentage cost of liquidity is 33% higher for VBIL simply because the NAV is lower.
33% higher. So if you are treating this ETF like a checking account, moving money in and out every few months to pay taxes or buy a car, that 1 cent spread acts like a toll booth.
A toll booth you hit coming and going.
Exactly. And because the toll takes a bigger percentage bite out of VBIL, that hidden trading cost entirely wipes out the benefit of VBIL's slightly lower annual expense ratio.
It eats it alive. The math basically dictates that for holding periods of less than a year, SGOV is genuinely cheaper to trade and hold because the spread cost is less punishing.
But if you plan to park the cash for multiple years...
Right. If you park it for years without trading it, the upfront spread cost gets amortized over time, and VBIL's lower 0.07% annual management fee will eventually grind out a mathematical win over the long haul.
Okay, so SGOV for the short term, VBIL for the long term. But Vanguard's research dropped a crucial execution pro tip to mitigate this entire spread issue, regardless of which fund you use.
Oh, this is maybe the most important takeaway for retail investors.
Definitely. Because these ETFs trade in the secondary market, you must always use a limit order.
Never hit the buy at market price button on your brokerage app.
Never. Because if there is even a momentary lapse in market depth, a market order might execute a few pennies above the NAV.
And in the ultra-low margin world of cash equivalents, overpaying by 3 cents on the purchase completely destroys a month's worth of yield.
It's gone instantly. So set a specific limit price to ensure you aren't slipping on the bid-ask spread.
Exactly. A limit order forces the market maker to meet your price, protecting your yield from those micro fluctuations in order flow.
Okay, so we've unpacked the SEC yield mechanics, the Fed's risk management easing, the sawtooth NAV adjustments, and the granular spread math of the SGOV versus VBIL showdown.
We covered a lot of ground.
We really did. Let's synthesize all of this into a final verdict for the listener. Based on the 2026 data, what is your ultimate buy, hold, or sell ruling on short-term T-bill ETFs?
All right. The verdict is highly dependent on the timeline of your capital. It is an absolute buy or hold if you have short-term, strictly defined cash needs.
Like the Vanguard and Schwab reports highlighted.
Yes. If you are building an emergency fund,
Hmm.
pooling capital for a real estate down payment, or holding tax escrow, the roughly 3.6% SEC yield combined with zero principal risk makes this an elite parking spot.
It's doing exactly what it's supposed to do.
Both SGOV and VBIL execute this flawlessly.
Hmm.
Like we said, utilize SGOV for liquidity inside of 12 months and VBIL for stagnant cash held for years.
Okay, and what about the scenario where the listener needs to hit sell?
It is a sell, or rather a reallocate, if this money is intended for long-term wealth building.
Because cash is dethroned.
Exactly. As the Vanguard analysts make crystal clear, cash is dethroned for total return portfolios. The Fed has normalized rates, and the yield on these T-bill ETFs will float downward. If you have a 5 to 10-year time horizon, you are actively losing total return by hiding in cash. You must move out the yield curve and lock in rates on intermediate corporate or municipal bonds before the macroeconomic environment shifts again.
It's really all about deploying the exact right financial instrument for the job at hand.
That's exactly it.
But, before we wrap up this deep dive, I want to leave you with a completely different angle to think about. We've been looking at this entirely from the perspective of an individual investor utilizing SGOV's $75 billion pool of assets for absolute safety.
Right, looking out for your own portfolio.
But zoom out and think about the macroeconomic impact of that safety.
You're talking about the opportunity cost of capital.
Exactly. That is $75 billion sitting in just one single ETF. If
Good.
you combine all the ultra-short treasury ETFs, money market funds, and retail cash equivalents, you are looking at trillions of dollars.
Trillions, just parked.
Parked with the U.S. government, earning a guaranteed yield, doing absolutely nothing to build the future.
Wow. Yeah, when you put it that way.
Right. It isn't funding a biotech startup trying to cure a disease. It isn't financing a new manufacturing plant or building housing infrastructure. When the risk-free rate is high enough, it essentially incentivizes the entire financial system to hoard cash rather than take the risks required to drive human progress.
That's a profound way to look at it.
We get absolute safety in our brokerage accounts, but what is the hidden cost to innovation when trillions of dollars decide to just sit on the sidelines and collect a 4% yield?
It's a massive drag on the economy.
It's a fascinating tension between individual financial security and global economic growth, something to mull over. Thank you for joining us on this deep dive. Review your asset allocation, check the SEC yields on your cash vehicles, and always remember to use limit orders. Catch you next time.